Good morning, everyone. Nice to see all of you together. It's a big crowd. I'll keep my presentation as relevant and as impactful for all of you. I'm Xun Xiang from LionGlobal Investors. For some of you who don't know me, just try to remember me as the ETF guy from LionGlobal Investors. So I head the ETF business here at LionGlobal Investors, and we are part of the OCBC group. So today I'm here to share with all of you about our LionGlobal Singapore Physical Gold ETF. So if there's anything I want you to remember about our ETF, remember three key things. First, we vault all our gold in Singapore. Singapore is geopolitically neutral. Second, we insure all our gold against loss, damage, and theft while in custody and transit. So this means that if there's any loss, damage, or theft, even when the gold reaches Singapore and is transported to the vault, all these are being covered and also insured. So not a lot of gold funds out there currently cover this. And third thing is that, in fact, our trading price is actually among the lowest among all other gold funds or gold ETFs out there. We are only trading at around USD $4 plus per unit. So it's actually very easy to enter in and out to be able to trade. And I also want to thank Weiren for mentioning about his positive views on short duration bonds and also China Tech earlier. It just happens that like global investors, we also have our own Hang Seng Tech ETF and also our short duration bond active ETF. So I think these are, if you are interested in these two, probably these are the two ETFs and ideas you can also consider. So to start things, like global investors, we are part of OCBC Group. We are one of the largest homegrown asset managers here within Singapore. Our total AUM is around $75 billion. And currently, we have this number of ETFs. And to keep this more interactive and also more relevant for some of you, I will also have some prize giveaway questions during my entire session. So this time I will start with maybe this side. On this side, which is the side facing this. Very, very simple question. You can count using the number of fingers in your palm. Simple question, how many ETFs do we have at our global investors? To that gentleman who raised both his hands. Yes, we have 10 ETFs. Just like how you remember the number of fingers you have, we have 10 ETFs. And in fact, we are the ETF issuer with the highest number of ETFs in Singapore and on SGX. So we have ETFs that cover, as you see, bonds, equities, commodities through gold, and also REITs. And we started our ETF journey back in 2017 when we launched our first ETF, which is the Lion Philippe S-REIT ETF. And today, we have already crossed our 10th ETF, which is the LionGlobal Singapore Physical Gold ETF. And this is the key ETF I'll be talking about. And if you look at data based on SGX, our ETFs are among the top 10 ETFs held by retail investors, by all of you, including myself. And if we zoom into the SRS segment, you will notice that our ETFs are also within the top 10 ETFs held within this segment. All these are based on SGX data, and the latest as of 30th of June. And based on trading volume, you will notice that in 2025, the whole year, our ETFs are ranked within the top 2 ETFs. So for example, our Hang Seng Tech ETF has been the top traded by volume for the past 4 consecutive years. And similarly, there's been around the top traded ETF this year to date. And for our REIT ETF, it has also been among the top traded ETFs for the past few years. So in fact, our bond ETF, once the 2026 data is out, is also among the top 10 ETFs by trading volume. So about gold, some of you might be interested about this topic because they've seen a lot of different ups and downs, a lot of volatility. So I think I will give some history, some color about gold. Key thing, for the past 100 years, which you see here, there have been history of gold confiscation in the US and the UK. So for example, in the 1930s, you will notice that around the Great Depression period, gold, there was forced convertibility. So this means the US government could buy back gold at a fixed price instead of the market price back in 1930s. In the 1960s, you will notice that there have been also similar events happening during the past 100 years. And the most significant event for gold actually happened in the 1970s when the US dollar was removed from the Bretton Woods Agreement. So in short, this basically means that US dollar was no longer backed by gold. And this means that since then, gold prices actually have spiked up significantly because US dollar no longer had to be backed by gold, and they could incur and also print money, start printing more and more US dollars without the fact that it needed to be backed by a finite amount of gold. So it's a significant development within the history of gold. And because of this, they led to huge appreciations within gold prices, even during periods where we've noticed for the past 50 to 60 years. The key periods this happened was in the 1976 to 1980 period. Gold actually spiked during the stagflation or oil shock periods. And also the period where we actually seen COVID happen. So all these actually are interesting developments which we have seen. And key thing to note is that gold should be positioned within a portfolio as a portfolio diversifier. Think of it more a bit like insurance. If things happen, gold actually, because of its negative or zero correlation with other asset classes, it is a diversifier. It's not meant to be an all-in, 100% all-in or 50% all-in kind of instrument. And during periods where there are elevated valuations in US equities especially, you'll see that actually gold tends to perform better. And this is what we have noticed throughout history. And whenever there have been market corrections, it's been since what we have noticed in year 2000, there have been around 10 market corrections. Gold actually returned positive in 9 out of these 10 market corrections. It's actually a significant showcase that gold is a portfolio diversifier in helping to return positive because of its low correlation with other asset classes. And if you think of it for gold, if you, let's say you hold a global portfolio, for example, around 45%, you have global equities around 45%, and also 45% USD fixed income kind of portfolio. If you just add roughly a 10% allocation to gold, which is also what FSM has been advocating, it has to be a portfolio diversifier. It's not an all-in kind of instrument. You'll notice that actually this helps to improve return, but with slightly lower risk. Improve return with slightly lower risk. So this is the purpose of gold, even in a global portfolio context, improving return, but at a slightly lower risk as a diversifier. And we see this same observation in a Singapore portfolio. If it's same thing, 45% Sing equities, 45% Sing bonds, just at around a roughly 10% allocation to gold, we see the exact same thing, exact same phenomenon. Increasing returns, but at slightly lower risk. And this is the purpose of gold as a diversifier to help cushion the impact of high-risk events or risk-off periods within your portfolio. So I think in terms of the long-term drivers of gold, we have seen a lot of gold price movements throughout. We have seen a lot of ups and downs. I think 3 key long-term trends still continue. First is central banks. They have been accumulating gold. They have been net buyers of gold for a long period. And second thing, that is the part about C. Second is about D, which is about de-dollarization, because central banks and also institutions are diversifying away from the US dollar due to the broader de-dollarization trend. Because the US dollar is not backed by gold, and the US has 30 plus trillion debt. So, and all these are expected to further continue. And third part is about gold being a long-term store of value, which has existed for 5,000 years. So in the first part on central banks buying gold, key thing to note, for the past 20 consecutive months, China has actually been accumulating gold for 20 consecutive months. So even regardless of the gold price movements, whether it goes up, goes down, on a disciplined basis, on an approach, China has been buying gold for the past 20 consecutive months. And we expect this to further continue because of this global broad trend of de-dollarization. And as you see here, for the past 5 years, I think especially for what you see within China, the largest increase in terms of gold reserves has actually been spotted within China. And we expect this to further continue. Second is about the broad trend of de-dollarization, where the whole world is diversifying away from USD. So a key thing to note is that if you look at this chart, there's an intersection point. So first, for the first time in 25 years, in August 2025, gold actually outweighed US dollar. Gold outweighed US dollar for the first time in 25 years as a portion of global reserves. So it's a significant event because a significant phenomenon because this hasn't happened for the past 25 years. And regardless of what the gold price movements are, central banks need to buy gold as an alternative form of reserve, especially since it existed for 5,000 years as a long-term store of value. And we expect this to further continue as the broad trend of de-dollarization and diversification of USD continues. Third thing is about gold being a long-term store of value for more than 5,000 years. So other than appreciating even during the financial crisis back in 2009, gold actually has appreciated in USD terms. So regardless of the ups and downs of US dollar, you will see that gold actually has appreciated a lot because gold is finite. You cannot print more gold, but you can print more US dollars. Same trend from what you notice among other global currencies or other Asian currencies, gold has actually appreciated while these other currencies depreciated against gold because gold is finite. The other fiat currencies can be printed. So these are the three key things to take note about gold because it is a portfolio diversifier, higher returns at lower risk. Second, during times of crisis, it is actually a safe haven. It has returned positive in 9 out of 10 market corrections. And third part is about long-term value preservation. So regardless of the ups and downs, it helps to preserve your purchasing power. Regardless of currency movements, it helps to preserve purchasing power. So I think there are a lot of different ways for investors to look at gold or invest in gold. You can buy a physical gold bullion like what I have here, a gold bar, but it might not be that easy. I will explain later why it might not be the most efficient method for investors to be able to access or buy gold. You can buy gold through ETFs, but some ETFs, they do not vault their gold in Singapore. So probably if there's something happens or if there's gold confiscation, there's risk of losing investment. Third part is buying through gold miner stocks, but that means you also take unique company risks because some companies, they might take on a lot of debt to be able to mine gold. So this is one thing to take note. So the ideal or optimized case is actually if you have one solution that vaults all the gold in Singapore, backed by physical gold, it is also liquid, easy to get in and out, but also at the same time, insured. Because the world is quite volatile now. If there's no insurance, if things go wrong, the gold backing your investment might not also be there. So I think these are key parts, and I believe these will be the key parts important for investors. So this brings us to the LionGlobal Singapore Physical Gold ETF. We actually meet all the 4 requirements. So we are fully backed by physical gold. And we vault all the gold in Singapore. Singapore is geopolitically neutral, zero history of gold confiscations, unlike what you see in the US or UK. And third part is that it is fully insured against loss, damage, and theft. So even if there's any loss or damage during the periods when it is stored in the vault, insurers will cover that. And if we compare it, let's say with other gold investments or instruments, if we compare with gold futures, there's rollover risk, rolling costs. So it might not be the most efficient way, and it's only used for sophisticated investors. If you buy physical gold, you have to arrange storage and custody yourself, because you have to think of all this, and all these actually add up costs, and it's not as efficient. And if you look at other gold ETFs out there, they mainly vault their gold in US or UK that have seen history of confiscation, and they are not fully insured. So this makes us the first gold fund fully backed by physical gold in Singapore, and so at the same time fully insured against a lot of different risk events like loss, damage, and theft. So all our gold is actually backed by investment grade gold. So when we talk about investment grade gold, those are the ones with the unique identification number, with the refinery name and all this. So it means in short, all the gold have their own NRIC. So they have their own NRIC, own passport, all printed onto the gold bar. They are uniquely identifiable. And we store them in Singapore, first because it's our home ground, like everyone here. And so at the same time, there's low risk on natural disasters. So because Singapore is small, and we don't see big natural disasters that are happening even around the region compared to other areas or other jurisdictions. And Singapore has very stable geopolitical relations. And geopolitical neutrality is important because this means that even if other institutions, they store their gold in Singapore, it is a trusted jurisdiction. And this is also in line with the broader national vision of creating and positioning Singapore as a gold trading hub and also gold storage hub. So all these are important and also why we store and vault the gold within Singapore. So the gold, if you are interested, is vaulted in Lovely Port. So I think I've been to the gold vault a few times. It is not easy to even locate the door to the vault. You think of it like Squid Games. You see a maze of different doors that actually look the same. So even to go and find the door, you'll take some time to find the door. And after you go into it, you still have to go through biometric verification. And after that, there's high security clearance and there's also a lot of security features inside. So it's a highly secure vault with very tight security. And for some of you who go and read the prospectus and all those, you will see the terms on allocated gold and unallocated gold. Actually, this is a unique thing which we disclose because a lot of the gold funds out there, especially those that were approved back in the 1990s or 2000s, back then regulations were not so strict. But all gold funds, they need to kind of have something called unallocated gold. Basically, it means that it is an account. Let's say if there's only enough cash for 399 ounces of gold, you cannot use it to go and buy a 400 ounce gold bar, which is what we hold. So in this kind of case, you hold that in an unallocated account. Once you hit 400 ounce bar, in terms of 400 ounce worth of cash, then you use the 400 ounce worth of cash to go and buy the 400 ounce bar. So this is what the unallocated account is there for, to be able to facilitate this kind of transactions if the amount is not enough, is insufficient for 400 ounce bar. So all gold funds, they kind of need to have this kind of unallocated account, but we choose to disclose them. We hold ourselves to a stricter standard to be able to disclose that we have unallocated accounts, to be able to show that all these are proper and also accurate in terms of gold holdings. And our gold ETF is the only one that is fully insured compared to the other gold funds or gold ETFs out there, as you see here, while being vaulted in Singapore. So I think the key highlight is that a lot of investors think, actually maybe it's more efficient. I go and buy a gold bar regardless of how big and how small. But you will notice something here. The bid-ask spread for the gold bar. If let's say you buy a 1 gram gold bar, you pay 22% bid-ask spread. So 22% bid-ask spread basically means something, let's say this thing, the true value is only $1. I have to pay $1.22 to buy it. And let's say if this thing still remains at $1, I sell it, I can only get back 78 cents. So I think this is the truth of bid-ask spreads. If you buy physical gold, you pay much higher for something of this value, and then you get back something of this value, but at a lower amount of proceeds. So actually you get charged both ways, when you buy and when you sell. So this is actually a transaction cost a lot of investors might not be aware of. So let's say if you buy a small gold bar like this, you pay transaction costs when you buy, and you pay transaction costs when you sell. But compared to a gold ETF out there, you don't have to worry about all this. All this is covered within the 39 basis point total expense ratio. So 39 basis point expense ratio basically means, right, let's say you invest Sing 1K, you divide by 365, every day is around like probably $1 or $2. So it's what you pay. And at the same time, you get storage, you also get insurance on the gold that is backing your ETF units. So it's a much, much more efficient way, while at the same time also liquid. You can buy and sell anytime you want. If you do not think the gold ETF currently expresses your investment view. So it's the beauty of gold ETFs compared to a physical gold bar, which can be not so efficient compared to entry and exit. So these three key things to remember: the benefits of a gold ETF, A, C, and E, is accessible. You can invest as little as USD $4 plus per unit, because the trading board lot size is only 1 unit. So it's easy to get in and out, and also to dollar cost average and build your positions. Second, you do not have to think and worry about all the logistics, especially storage. Secure storage. It's not something you have to worry. And third thing is about efficiency, because it's much, much more efficient compared to buying and after that storing, and then after that taking out and going to sell the gold bars. The gold ETF will take care of all this for you. So actually, if you look at it in terms of because for our gold ETF we track the LBMA gold price AM, which is the benchmark. So you've noticed that we have closely tracked the benchmark. And in terms of the unallocated gold holdings, is right now still below 5%, which is what we disclose within the prospectus. And key thing to note is that as the fund grows bigger and bigger, this percentage on unallocated gold will decrease. So, and every month, once we collect sufficient cash in terms of to hit the 400 ounce bars, we will deploy it to be able to ensure that all the unallocated gold, as much as possible, becomes allocated gold, which is the physical gold that will back the ETF. And if we compare it, let's say with other gold ETFs out there, like GLD or GLDM, you'll notice that in terms of performance, because both of them, they actually track the London PM price, 3 PM price. Ours, we track the 10:30 AM benchmark price. You will notice that in terms of performance, is rather comparable. I mean, maybe we slightly outperform a bit, but the key thing to note is performance is comparable. So you are not losing out on any price movements in terms of gold price comparison. So I've come to the final few slides of my presentation. So this is where I'll have more price giveaway questions. This time I open it up for the middle side. Very, very simple question. What is the Sing dollar ticker for this gold ETF? To this gentleman. Yes, it's GLS. And then you will see that GL sounds a bit like gold. But the reason S is there is to stand for Singapore, Sing dollar. It's not easy to ask SGX to chope all these stickers beforehand, but we managed to do that. GLS, Sing dollar version of the gold ETF. Next question, I'll open it up for the floor up here. What is the USD ticker for this gold ETF? To this gentleman. Yes. Yes, GLU. So GLU, U stands for USD. Easy to remember. And another thing that is interesting in terms of pronunciation is that GLU sounds like glue. So I mean, we hope this keeps you attracted to the ETF, like how it will help glue your different parts of your portfolio together, and how GLU can be a portfolio diversifier for you. I'll have my final question for price giveaway question for this. Very, very simple question. What is the listing day of this ETF? I open it up to that lady. Yes, to you. Yes, 26 March 2026. So it's a very easy date to remember, because that time when we were listing that, we were thinking of which feng shui date to choose. There were 226, so easy date to remember. And at the same time, what you will notice is that we have been listed only for 3 months. But because of what we see in terms of interest into gold, the AUM and actually the number of ETF units actually more than doubled since our listing. Because there have been a lot of big interest into gold, including by institutions, which are starting to accumulate gold at attractive entry points. So this is also the final message I want to end for all of you here. GLS and GLU. Long-term drivers, central bank buying gold, being net buyers of gold. Second is also the fact that this gold ETF, physical gold holdings are fully insured against loss, damage, and death. Remember GLS and GLU. Thank you.